Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TETRA Technologies Inc. quarterly report. TETRA Technologies Inc. offers a diverse range of energy services and solutions through its two primary segments, completion fluids and products and water and flowback services. The company's businesses include manufacturing and marketing of clear brine fluids, additives, and associated products for the oil and gas industry, marketing of liquid and dry calcium chloride products, supplying TETRA PureFlow UltraPure Zinc, bromide to battery technology companies, providing water management services for onshore oil and gas operators, offering frac flowback, production well testing, and other associated services in various regions worldwide. The stock price of TETRA Technologies Inc. has skyrocketed by as much as 124.61% and 163.73% in the past year due to several key factors. The company's strong financial performance, including a net income and increased sales, has been a major contributor to its growth. Additionally, TETRA Technologies raised its full-year EBITDA guidance and unveiled its ambitious One TETRA 2030 strategy, which aims to more than double revenue by 2030. The completion fluids and products segment showed particularly strong performance, with revenues increasing 39% compared to the previous year. The company also secured new contract wins in international markets, including Argentina and Saudi Arabia, which are expected to significantly boost revenue. Furthermore, TETRA Technologies' Arkansas bromine plant project is progressing on schedule and under budget, projected to add an additional $200 million to $250 million in revenue at full capacity. The company's strong balance sheet, financial resilience, and focus on low-carbon energy solutions also position it for growth. Analysts have issued positive ratings for TTI, with the average analyst rating being buy. Overall, TETRA Technologies' robust financial performance, strategic outlook, and emerging industry trends have contributed to its significant stock price increase in the past year. The primary drivers of revenue growth or decline can be identified through an analysis of the company's financial summary. The completion fluids and products division is a key contributor to revenue growth, driven by strong results from offshore and industrial calcium chloride businesses, deepwater Gulf of Mexico projects, and seasonally strong industrial chemical sales in Northern Europe. In contrast, the water and flowback services division has experienced a decline in revenue, attributed to decreased onshore activity in the United States and the sale of early production facilities in Latin America. These factors have resulted in a 13.8% decrease in revenue compared to the first 9 months of 2024. The main drivers of revenue growth are stronger volumes from deepwater completion fluids products, completion of 3 CS Neptune wells, strong results from Northern Europe industrial chemical sales, and North America TETRA PureFlow UltraPure Zinc bromide electrolyte sales. Conversely, lower U.S. drilling and completion activity, as well as the sale of early production facilities in Latin America, are the primary drivers of revenue decline. Net income and profit margins. A shift in fortune, the financial performance of a company has undergone significant changes between Q3 2024 and Q3 2025. Net income, which was a loss of $2,998,000 in Q3 2024, turned into a profit of $4,151,000 in Q3 2025, marking a substantial improvement of 251% year-over-year. The YTD net income also saw a significant increase from $5,557,000 to $19,505,000. However, the profit margins have not followed the same trend. Gross profit margin decreased from 24.2% in Q3 2024 to 23.8% in Q3 2025, while operating income margin decreased from 8.4% to 7.3%. On a YTD basis, gross profit margin increased from 23.4% to 26.4%, and operating income margin rose from 9% to 10.9%. The reasons behind these changes are multifaceted. The improvement in net income can be attributed to the reversal of foreign currency translation adjustments and other factors. Additionally, higher revenues and gross profit have contributed to the increase in net income. Meanwhile, the improvement in profit margins is due to an increase in operating income and working capital changes. Overall, while net income has seen a significant turnaround, profit margins have been less consistent, highlighting the complexities of financial performance. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The net cash provided by operating activities has increased substantially from $30,885 in 2024 to $68,634 in 2025. This increase suggests that the company is becoming more efficient and effective in managing its day-to-day operations, resulting in a positive operating cash flow. The company's debt level and interest expenses have undergone significant fluctuations over the past year. While some periods show a decrease in interest expenses, such as a $3,867,000 reduction, minus 22.4%, on page 44, other periods reveal an increase, including a $254,000 rise on page 38. The company's debt level has also experienced changes, with long-term debt increasing from $179,696 million to $180,924 million on page 26. However, the Swedish credit facility had no balance outstanding as of September 30, 2025, indicating some variability in debt levels. Overall, these inconsistencies suggest that the company's financial situation is dynamic and subject to change. The company's financial performance reveals a mixed picture across its segments. The completion fluids and products division stands out as the top performer, with a remarkable 292.7% revenue growth and significant operating income of $91,016 over 9 months. In contrast, the water and flowback services division struggled, posting an operating loss of -$83 for the same period. Meanwhile, the corporate segment also underperformed, recording an operating loss of -$38,046 due to minimal capital expenditures. Management is optimistic about the company's outlook, highlighting several key strategies. The company plans to expand into the low-carbon energy market by leveraging its chemistry expertise and global infrastructure. This expansion will focus on 3 main products: TETRA CS Neptune Fluids, TETRA PureFlow Plus Electrolyte, and Oasis Total Desalination Solution, TDS. Management expects significant growth in demand for these products, particularly in lithium and bromine extraction. The company is prioritizing strategic initiatives that can drive near-term results. Key projects include the completion of a first commercial plant for TDS water desalination technology by 2027 and the installation of a new bromine processing plant in Arkansas by the end of 2025. Management also sees opportunities to extract lithium, bromine, and other minerals from the Evergreen Brine Unit. Overall, management is confident that these strategies will drive growth and enhance shareholder value. The company has made several key transactions in its financial dealings. In terms of acquisitions, the most notable move was the exercise of an option to extract lithium from Arkansas leases on October 6, 2023. On the divestiture side, the company has discontinued certain operations, resulting in a loss of $5.83 million for the 9 months ended September 30, 2024. Additionally, it sold shares of Kodiak Gas Services, Inc., for $19 million in January 2025, and also sold an early production facility expansion in Argentina. The company's financial summary reveals that as of September 30, 2025, no dividend payments have been made nor have any share buybacks occurred. This indicates a conservative approach to shareholder returns and capital allocation. Concerns about inventory buildup and supply chain disruption, the company's financial summary raises red flags regarding its inventory management. A significant increase in raw materials inventory by 228% from $1,599 to $5,271 suggests a buildup of unsold or unutilized stock. Furthermore, the outstanding letters of credit worth $1.6 million against the Finland credit agreement indicate potential inventory obligations, which could lead to supply chain disruptions if not managed properly. These concerns highlight the need for the company to reassess its inventory management strategies and mitigate potential risks associated with inventory buildup and supply chain disruption. That concludes the financial summary for TETRA Technologies Inc. Feel free to comment below, and I will be happy to answer them when possible.